We are back in the black hole of real estate. I wanted to talk today about private mortgage insurance and why it might actually be a good idea to just pay it. This is your host, Ron Wysakarski, for the black hole of real estate. And private mortgage insurance is something that occurs when a buyer is going to get a mortgage and puts less than 20% down. So it's not homeowners insurance that protects the house for the owner. It's actually insurance that's in place to protect the lender of the money who's providing the mortgage to the buyer in case of default. And the reason that's put in place is that there needs to be a safety net of money if the buyer, for their own reasons, can't make the payments or chooses not to make the payments, and there's a foreclosure in there, the bank would stand to lose money for the privilege of loaning the money. And so this was to mitigate the risk involved. What it did was it provided an opportunity for buyers that didn't have 20% to put down on a property to still buy a property, or to more easily do that, and the rates be less punitive. You see, with the insurance is in place, it means the risk goes down. That means the rate could also be lower, and it follows in that sequence. Without that insurance in place, then what you would likely see is a mortgage rate much, much higher if the buyer was even eligible or able to be approved by the lender. And so why would somebody want to pay mortgage insurance? Well, if we did the math on this, and I think it's pretty basic, you can go to almost any mortgage calculator and figure out a payment with and without the mortgage insurance premium. But here's what I'd say. Let's just suppose that your mortgage insurance is $150, $200 a month, in that range. And we'll take the lower number of 150. It's about $1,800. The higher number, $200 a month, 24. Let's just call it $2,000 a year. And if we take that and we say for the first 3 years, $6,000. That's going to go towards the mortgage insurance premium. Whereas if you were to put more money down to 20%, you might save that 6%, but almost all the money in the first 3 years is going to interest. And if you look at an amortization table, what you're going to find is very little money goes to principal. Very little. Probably less than $6,000 over the first 3 years. So when that happens, what it means is you're not avoiding anything in the first 2-3 years, or a negligible amount. Now, during those first 3 years, a number of things might happen. A buyer may choose to sell the property. And if that's the case, the mortgage insurance wasn't for life, it was for 3 years, but they were able to avoid a much, much larger down payment. And to give you some scale on this, let's suppose we're looking at a home at $300,000. 20% of $300,000, $60,000 plus closing costs. So a buyer would need to put about $70,000 into a property, $60,000 down payment, and let's just approximate $10,000 for closing costs and insurance. It could be more or less, but let's just approximate that. Whereas, let's say they put 5% down of $300,000, $15,000. And if we even said the closing costs were the same at $25,000, what I'm finding is there's a difference of $45,000 that doesn't have to be put down in a house. And if you had the $45,000 in some sort of an investment that was bringing back, let's say, 4%, that 4% of the $45,000 is about $2,000 a year. So I would argue that even if you had the money, you might be better off to just keep it in the investment if it was making about 4%, if it was saving the same amount that you're paying in mortgage insurance, because the mortgage insurance can eventually go away in a couple of different ways. It could go up because you sell a house. It could go away if you were to refinance. It could go away if you did an addition or added square footage or value or renovated the whole home and kept the same mortgage, but petitioned the bank to lower it, or remove it, I should say, And they will typically have you pay about $600, $500, something like that for an appraisal. And when that appraisal comes back, as long as you've got better than 20% equity, then they can waive it. And then it's just gone. Now, this doesn't work for an FHA loan because they made that for life a few years back. So if you have an FHA loan, once you got mortgage insurance, it's yours to keep. But wouldn't it make sense to at least examine the difference between investing $70,000 at closing by putting 20% down, and this is for a $300,000 purchase, versus a whole lot less, about $25,000. $70K, $25K, a difference of $45K. Not everybody has that kind of money laying around, and if you do, I would just examine the numbers. What would make the most sense? Knowing that in most cases, you're able to make it, the mortgage insurance, go away eventually. Now, if we skip back to the lender side, because it's got to make sense to both sides, if the buyer, for whatever reason, bought a property for $300,000 and they stayed in it for a year, and let's say they paid it down $1,000, $299, $2,000, $298, very little pay down. If they went back on the market in the next year, they're going to have closing costs, and let's just guess 8%. Commissions, there's going to be title insurance fees, conveyance fees, there's moving fees. Let's just say for a minute, closing costs are 8%. It's $24,000. So the house selling at $324 after the closing costs would get the seller back about $300. They'd pay off the $298 or $299 mortgage, put about $1,000 in their pocket. But what if? Let's say the home did not appreciate 7% in the first year. Let's say it appreciated 3%, which is a 100-year rolling average, even 4%. That's within that range we've seen historically over time. So if we just said the difference in a $9,000, $12,000 increase, let's just call it 10. House is now worth $310. You sell it, and even if your commissions and closing costs were $20,000, you're still at $290 that you've got netted back to you at closing. And if you owe $298, you're going to write a check for $8,000. And for some people, they can't do that. They just don't have it. If they had the $8,000, they'd figure out the hardship, or they'd keep the property or something. And this is where you can see a foreclosure, a short sale, or something like that, where there's a remedy in place, and the buyer throws the keys on the counter, bank takes it back. But the bank is missing a lot of money here because they've lent all this money out, and they're not even getting back what they put into it. And this is where the mortgage insurance kicks in. And this policy would make the lender whole or almost whole on whatever loss. And if we're looking at a 20% factor, then you can see where the bank, they may or may not profit off of this, but if they were missing $10,000 or $20,000, they can tap into this mortgage insurance and probably get the rest of the money back, and they'd have the house that they could sell as a foreclosure at some point down the road. Now, keep in mind, in a rising market, well, that must be great for the bank, but in a declining market, the bank could be hit even beyond, that 10 or 20% premium, where they're going to get some of that money back because they're going to have repairs, renovations, they're going to pay closing costs on the other side. There's a lot involved for the bank. So look, I don't feel sorry for the bank. They know the risk, but I also know that risk involved there is what causes fees and things to be a little bit higher, or maybe a lot higher. So if you are looking at a home or avoiding purchasing because you feel like you have to have 20% down, either because that's just how you understood it, or maybe someone just told you you have to have 20% down and you just never dug any deeper into it. The fact is, in most cases, you can put a lot less down than 20%. A VA loan, 0%. A USDA loan, it's a rural housing loan, 0%. That's the two 0%, but FHA is 3.5%, and conventional can be as low as 5%, and you may find a 97% loan with 3% down at some of your credit unions under community programs. So look into those things. They'll have mortgage insurance, but I've kind of given you the numbers on how it might actually make sense to just pay the mortgage insurance premium and get into the role of being a homeowner. This is your host, Ron Wysakarski, for the Black Hole of Real Estate.